Housing is one of those large costs that we all take on. Owning a home is a dream for many, yet paying for it can be overwhelming. Today, I'll explain how you can make it a productive part of your plan, be it renting or buying, how to get the best terms on a mortgage, or how to earn that lucrative rental income. We'll cover it all and more. Hi, everyone. Welcome to episode 13 of the Escape the Clock podcast. If you're joining me here, then hopefully you've been caught up on the previous episodes where I've been breaking apart parts of the book and talking about how to make saving plans, getting into investing, getting ready for retirement, or even the way we think about work and life. I try to touch on all these topics and they can all be pretty big, and so I dedicated an episode to each one. And last week, I got into taking on borrowing, in particular, thinking about debt and how to leverage it effectively, how to avoid those sharp edges that can get us. And it was a really big topic. I think, if you caught it, you might have to go back and kind of pick out the parts that might be more relevant to you, or, think about a follow-up episode in the future where I might even get deeper into some of these different ways to use borrowing effectively, because borrowing is a big part of life. And that's what today's topic is going to be focused on. Both this week and next week, I'm going to talk about some of the biggest costs in life, costs that are so big, they force us to borrow. And this week, it's going to be about housing. And it's not like you're always guaranteed to borrow. Not everyone's going to end up getting a mortgage in their life, but still rent can be expensive, dealing with the housing market, just, housing in general. And I think there's a lot of things here that kind of surprise us on our journey, be it how we find a place to live, the hidden costs with home ownership, and not just maintaining the home, but just closing on the loan. There's a lot of pieces to that, and it can be hard to understand them in the moment, especially when you're excited to get your new home, and also you get a lot of pressure. You have agents there, you've made an agreement to close out on something, and it's hard to go through those hundreds of pages that are put in front of you that you have to sign over and over and over and nitpick and understand everything. Now, I'm not saying that you aren't the person to do that. Maybe you are, but a lot of us, we kind of just do the best we can. But I'm hoping that you use some strategies and projects here to help educate on how to do that as effectively as possible, and to make good decisions for our financial plans. Because home ownership should be something that we consider. It can be both something we think about mitigating because the costs are so high that we need to think about how to make sure they don't burden us as we try to hit our other financial goals. Or they can be an intentional strategy that we use as part of our financial goals, be it leveraging a house that you own for rental income, or rolling up by owning a home, and a smaller home, and hope, picking a place that might appreciate so that you can get more capital to roll into a larger lifestyle. There's a lot to cover here, and I'll do that in a moment on the projects. But first, let's set a little context. First, I want to set the stage before we get into the projects by looking back a bit in history, setting the stage with a crash that happened back in 2008. We saw one of the most devastating housing crashes in U.S. history. But what caused it? There were really two major things. The first was subprime lending, which were banks were giving mortgages to borrowers who really just couldn't afford them. And also the financial system was over leveraged through mortgage-backed securities, which bundled risky loans like the ones they were giving out through the subprime lending, and that just spread the risk globally. These two things piled up, and when the loans started defaulting because people couldn't afford to make their payments, it wasn't just a housing issue anymore. It actually triggered a global recession, and over 3 million US homeowners ended up losing their homes. And imagine that. I mean, maybe that was you, or maybe you knew someone that lost their home during this time. It was a very large catastrophe that happened, and it required the US government to really lean in and do a postmortem, and they ended up tightening all the lending standards as a result. And that did improve loan quality. So that history of what happened in 2008 has really set the stage for how lending is working today. But that core issue of affordability, that never went away. And that crisis has continued. I'd actually argue it's really grown, and it's become one of the largest serious problems facing the United States today. So nearly 1 in 3 households in the US are cost burdened, and they're spending more than 30% of their overall income just on housing. A third of all the money you're bringing in just on housing, and this can be your rent, this can be paying your mortgage statements, this could be maintaining your home, all these things. It just adds up. It's become more and more expensive. And as a result, home ownership has just been declining. It's actually now at 65.9%, which is lower than the peak that we saw back in 2004, which was around 69%. So about a 4-point drop. It's just too expensive and risky to own a home. And it's just because house prices have just skyrocketed. The median home price is over 30% more since 2020. And that's according to the National Association of Realtors. So people just don't want or can't afford to pay a third more for a home. And that's just added to the volatility of the overall mortgage rate environment. So now, and as this recording in 2025, 30-year fixed rates are hovering between 6.5% and 7%, which means buying a home is more expensive than ever. Higher interest rates, which I'll cover later in the projects, mean higher monthly payments. And that just cuts many, many buyers out of the market entirely. Young people, people that just have lower income, or just honestly aren't willing to pay such a high premium for a home. They really just can't afford it. So today, mortgage stability is rough. Mortgage defaults are still low, though, under 1%. So that's the good news. But it might not actually stay that way, because what we're seeing is a combination of high prices, rising interest rates, and stagnated wages. That's a volatile combination. It means people are stretching more to afford homes, and that's a bit of a red flag. So what we might see is defaults, more defaults, just like back in 2008 when that crisis occurred. I'm not trying to be here to predict another crisis, but the climate's not great here. So there has been pressure, though, from institutional investors on this, and others have been really putting their hat in the ring, pushing hard to try to solve this problem as well. But especially for first-time home buyers, there's large companies buying up single-family homes. There are buyers who are able to make all cash offers, outbidding other people. This kind of thing is pushing up prices. It's reducing the options, and it's just making it next to impossible for first-time homeowners. So this institutional investing into real estate can contribute a lot to the problem. So all of this, just to sum up, paints a very different housing market picture than just 10 or 15 years ago. So you might think, you know what the housing market's like because you bought a house before. But a lot of things have changed in the last decade. And so if you're planning to buy or sell or even invest, it's critical to understand all these dynamics so that you can build a good plan around it. And that's what I'm going to try to do today. I'm going to try to unpack all the different nuances of how to calculate should you rent or buy. When you buy, what do you need to keep in mind to get a good terms on your loan, different things you can do to treat your investment for what it is, an investment, and be able to keep going. So next, let's talk about a few scenarios to help us ground it all. Our first individual today is Irving. He's moving out of his parents' home after having just graduated. and starting his first job. And he's trying to decide, is renting the right thing to do, or could he go ahead and jump in and buy? He's trying to weigh the flexibility of, renting against long-term gains of home ownership. And for buying a home, he's just unsure. How much down payment would I need? Is my credit score good enough? What other costs are there? What would add up? What might get me there? And is it even the right thing to do? So I'll circle back to him at the end, and we can try to talk about how he can use some of these projects to make the right decision there. Our other person today, though, is Maria, and she's actually looking to start to create rental income for herself. She has $300,000 in cash from selling some stocks, and she fully owns her home. She's thinking of moving to a lower cost of living area and buying a rental property. She's unsure, though, how to vet the markets, assess cap rates, and understand what type of responsibilities she might have as a landlord, including tax implications. So we'll talk about her journey as well and how she might become one of those people who capture that lucrative passive income when it comes to rentals. Project 1 is about finding your forever home. It doesn't necessarily have to be your forever home. This project is about intentionally building homes into your overall financial plan. And it's pretty straightforward, really. If you've been listening to me go through other projects and other episodes, you won't be too surprised here. The first is setting your SMART goals. If you're not sure what SMART is, I break it apart in the book. I talk about it in other episodes. But really, the simplest reason to explain it would be to say that they're measurable goals that are very attainable for you, and they're relevant to your current situation. And in this case, housing is always going to be relevant. You have to have a roof over your head, and thinking about what your goal is for that being now versus later in your life, is just about dreaming. Dream up, what is right for me? What do I want? If for a younger person, this could be deciding about renting versus buying, but someone who's just getting married, it might be we're going to buy. It's about trying to figure out where we should live and making sure that it's a place that would work for a growing family. For retirees, it can be a lot more about ease of access to certain amenities or family, or really ensuring that the house fits your needs. Maybe it's just a one-floor home to avoid stairs. There's lots of things you can do when we think about our goals and our needs. So here, consider your ideal time frame, the location of the home, the size of the home, how much you're willing to spend on it. And you can capture all that into a single SMART goal. And just solving this one here is like basically the next set of tasks in this project, which is you're going to be able to find the home. But first you need to understand what you're even looking for. I mean, you might do this implicitly today when you're looking for a home. When you go in and you set up the search filters, you're really doing these things. You're saying how much you're willing to spend and where you're willing to look, and the type of home you're willing to live in. You're just capturing this into your plan as a SMART goal. And this isn't really a one-time task. You could do this multiple times through your life. You could have yours for when you're, in college, and then you could have a different home when you're working, and then married or not married, or moving into another country. Anytime your housing need changes, you can really think about what that goal is, and then you can go through and you can work towards it. Which takes us to the next task for this project, which is how do you go about even researching and finding the right home based on your goal? This is a research task. It's pretty straightforward. You have a good idea of what you're looking for. So you need to start to consider, though, your deal breakers here. Like, what are your must-haves versus your nice-to-haves? This is one thing that can help a lot, because really what this comes down to is finding leads and going in and knowing the right questions to ask. It's showing that you're thoughtful, you're thinking ahead, and you're trying to make the best investment possible. So, there's some things you might start to ask yourself. Are you planning to have a family in this home, or do you already have a family? Will it fit your family's needs? So you might need to consider nearby schools. If work is a big focus of your life, you might want to think about, can I optimize my commute? Is my commute going to be painful? Do I have public transit options? Or is there a reasonable carpool or drive option? If you're remote, you might want to think about, look at the internet providers. Do you get the kind of bandwidth that you want? For me, that hurt me when I moved into my home. There was literally 2 internet providers, and they both were not very good. But eventually, fiber became an option, and I jumped all over that. So that one, in retrospect, could have been more thought out in my financial plan. But of course, a big one's going to be always cost. Cost is big, and there's a trade-off to cost, right? The location, the types of amenities in the home, the age of the home, all these things come and impact the house price. So it's good to think about where you're willing to make trade-offs when it comes to your budget. Are you willing to live a little bit more remotely to get more house for less price? Or are you willing to sacrifice house size so that you can live more in a city or closer to a job? Whatever it is, you're going to plug those into one of these real estate platforms, right? This Zillow or Redfin. You can even use census data to search if you really want to. But anyways, what you're trying to do is look through the markets. You plug these criteria into your filters, and ideally you'll set up notifications or something. And the goal here is not just to do one search. Like, you're not going through your plan just to say, go do a search. You're really trying to create a virtual agent for yourself, a virtual buyer's agent, where you're creating the right save filter that's constantly searching for you and notifying you that there's something that meets your goals criteria. And when there does, that's meaning you have an opportunity to jump on something. And now, of course, you might have a time constraint. You might say, we need to find it. We're moving for a job or something, and we have to have a house there. Completely get it. And your project might be more along negotiating for good relocation benefits for the job or something like that. Or ensuring there's a buyer's agent applied to you, or you find a good buyer's agent to go do this type of work for you. Regardless if you do it yourself, or if you find a buyer's agent, or you negotiate something through your work, whatever it is, you want to make sure that you're constantly putting a net out there and understanding these markets so that you're going to get the best match for your needs. And the reason I'm harping on this is because buyer's regret on a home is one of the most painful things to have buyer regret on in your life. As I'll get to later in the mortgage and the borrowing that we'll go through, you really need to be able to lean in and settle into the home as long as possible to get enough value out of it. And so if you're buying something and it's not working for you, and you have regrets and you decide to move, there is a cost to that, and it will set you back in your financial plan. So ideally, a little bit of pickiness is good here, finding what you want and knowing where you're willing to compromise, because you can always improve things. You can always adapt. You'll never find the perfect option, except unless you decide to maybe build, which can be an option later, potentially in life, maybe part of doing this project again for retirement, which is one thing that my spouse and I are talking about right now. But it doesn't have to be buying. Renting and buying is a debate that many make. And renting right now, as I talked about in the context for this episode, is a more popular decision that people are making because the price to rent ratio is pushing people that way. And you might, okay, what's the price to rent ratio? This is actually something you can calculate yourself to help decide if we're in a buying market or a renting market. So it's hard for anyone to tell you should rent, you should buy. People always have that opinion. They'll probably tell you what their preference is and what you should do. But I'm saying, you can use a little bit of data here. To do this, find a home that you'd be interested in living in and grab the home price, the asking price. And then just divide that by rent, that you would be paying instead, annual rent. If the ratio that comes back from that division result is under 15, then it suggests that buying is probably a better option. But if it's over 20, then renting would be the better option for that home. So this is, as you can see, when the buying prices are more competitive, these price to rent ratios will get better, will go lower. But when those prices are high, rent might be the better option to wait it out until you get into a better buyer's market. Buyer's market meaning that the prices are better towards the buyer of the home. Seller's market clearly would be those who are selling homes would be getting the better deals. So the goal here is to wait for a good buyer's market, and you can use a price to rent ratio to help determine if you're there or not. And again, the idea is mitigation. This is about risk mitigation. Renting is a good way to mitigate a bad market. And even if you decide to rent, keep in mind, you keep those agents running. They can always run in the background. And while they're running, you can be saving. The more down payment you have, the better. And I'll cover this later, but down payment is your best tool to get a good loan and to get in a situation where you've really gotten the most out of that asset. So even if you're renting, don't think of it as a forever thing. If you don't want it to be, think of it as a short-term, time frame to build up your down payment. And you can even set a goal for yourself. You could say, I'm going to buy $800,000 home. And then you go say, okay, I need 20% at least or more. And more is good. So also, as these agents are running, as opportunities are popping up, as the market's warming up for you, now you can start to think about, okay, I'm seeing lots of different listings. I'm starting to pick into them. Maybe you even go look at some of them, even if you're not ready to buy yet, because you're really trying to get a sense of comparables. Look at one house versus another, get an idea what you're really looking for, and learn how to look for deal breakers. Because what you don't want to do is have your blinders on and then end up with one of those big regrets and then hop around. And again, a certain level of compromise is unavoidable. Know what's okay to compromise on, the things you can't live with and the thing they might force you to move on. Like commute is my favorite example. Commutes cause a lot of stress, a lot of lost time. If there's an area with a lot of congested traffic, that's going to cause daily stress. You'll have less time at work, less time at home. It just adds up, and it just, it can make it not worth it. The other thing to think about is things like flood zones or other natural risks. This can cause anxiety to where you're living if you're worried about damage to your home, but it can also significantly increase your insurance premiums. In some cases, you won't be able to get insurance at all. I've heard in some areas, insurance companies just stopped offering fire insurance because the risk is too high for them to have to pay out. So, be honest. If the deal is too good to be true, there's something there. You're going to want to go figure out what that is. And if you can't get insurance on your house, that is really, really risky. Yeah. So the other thing to think about, though, is HOAs, homeowner associations. Sadly, these have become unavoidable. They can also be pretty significant. These are basically costs that you're going to have to pay annually, maybe monthly, to that association. Hopefully they're providing you some value, but not always. But the good news is platforms now like Redfin, they'll list the HOA fees. So you can at least see it up front in your search. You can even put it in your filter. You can say, I'm not going to pay more than $3,000 a year in HOA fees. And you can try to do that. Just keep in mind, HOA fees they're going to be set sometimes and by in a whole community, like a whole city area, and they're just going to be high all over that place. And so you can't really negotiate. Still, it's worth asking the agent and the seller what they can tell you about the HOA itself. In particular, what issues have come up and what benefits do they provide? You want to know what you're paying for. If the HOA is going to do lawn care service for you, that might be great. You're like, okay, I'm getting some value out of this money. But if they're not doing really anything, maybe I think ours does like one thing. They make sure that we have one specific type of insurance paid for because we have a lien on one part of the land in our community. That's pretty much it. Other than that, they just, cause trouble. And that's just my experience. Others might have really great experiences with HOA. I so far have not seen a lot of value out of them, just cost. But I know people have good experiences with them and they can provide real value. Just ask, try to find out what it is. The last thing to consider would be resale or future rental income value for that home. When you're selecting a home, it's not just about the cost. It's good to think about it as an investment. The home is likely to appreciate, but it's not guaranteed. So you want to look for homes that are more likely to appreciate than others, just like picking a good stock. You want something that's going to grow in value. I wouldn't say that's your number one thing, right? Like if it fits your needs, your family's needs, that's probably arguably more important than you're going to get some huge appreciation on it. But at the same time, you're making a financial plan. So you should at least think about this. And there's things you can look for here. For instance, the area that the house is it having population gain? Has it stagnated in population? More people means that usually there's going to be more appreciation of the homes there. There's more demand for homes, things like that. Also, you can look at the nearby cities as well. This actually happened in our area. There was overpopulation in all the nearby cities to our town. And there's kind of like a overflow that happened. People needed homes. They couldn't afford to find homes in the cities nearby. So they were willing to go one city further, which ended up being where we are. And that made a ton of appreciation for the homes that were already here. And the demand went way up because so many people were overflowing. An obvious one is industry. If a factory is being built or some industry is coming in town, that's really good. People want to live near their work, so the value will go up. Renovations, like our town had this as well. They did a whole downtown renovation. They buried all the power lines and they fixed up, the appeal. It's beautiful where we live now, and we've seen a lot of value come out of that. So just think about things like that, anything that might increase the home value. The very last part of this project to think about, and this doesn't need to be a task if this isn't something applicable, of course, but it is relocation arbitrage, which is where you intentionally move from a high cost area to a low cost area, but keeping your income. That last part's actually really important. If you're not keeping your income, it's just moving. And, I'm saying this is an actual intentional financial strategy. The relocation arbitrage is a strategy where you're actually trying to get more cash flow in your life simply by moving. And there's a lot of things I cover in the book here, but going to a low cost area is enough to satisfy this. But you could also consider downsizing your home. Smaller home means smaller cost of living a lot of time. Not guaranteed, but it really can. Less to maintain, less purchases coming in, things like that. So think about those kinds of things and just access, right? If you have more access to things, your transit costs might go down. Taxes. Think about property taxes, income taxes, city taxes, all that stuff. These all add up. And it can really, really accelerate your financial plan. Also, a lot of jobs have become more remote friendly since the pandemic. And so I'm not saying that all of them will provide this option, and it actually can be a little risky. But if a job is remote friendly, then, or you're already remote, relocation arbitrage is a great option for you. But if it's maybe an option, but there's a risk that your job security could be on the line, just be honest about it. Don't trade your cost of living for a risk of losing your job. Like that, that could be really tough, especially if you move to a lower cost area that doesn't have a good replacement job at that income level. That's actually introducing risk into your plan instead of doing what we're looking for here, which is to mitigate it. So also one last note here, if income isn't even a concern for you, or like someone like me in an early retirement, moving to a lower cost area is just smart. I'm in a high cost area right now. And so the only thing holding me here is I have a daughter. I'm trying to wait to finish high school. I don't want to move her out of her school, but a couple of years she'll be moved, she'll be done, and she'll be off to college. And my spouse and I have already decided, we'll move to a more affordable area. We'll build a house that more meets our needs and that we can optimize. You don't have to do that, but it can, these ties can be loosened and you can make good, smart moves from it. Project 2 is about taking on that mortgage. Mortgages are the potentially largest loan you'll ever have in your life. They can be quite scary. And there's a lot of paperwork involved with doing that much borrowing. And so in this project, though, I think there's some tasks you can consider to make smart moves when it comes down to the decisions about things that impact the terms of that loan. And really, saving more, borrowing less is always just generally a good idea. In the case of a mortgage, it's the down payment. So the more money you're putting down, the more favorable the terms of that loan will be towards you. And I know there are programs that will waive down payments and things like that. I'll cover that in a minute. But down payments typically can range between 3 to 20% of the agreed upon home price. So there's going to be an asking price, a listing price. I would highly, highly recommend negotiating. So if you've not bought a house before and you're listening to me, you don't take that price. You always offer something else. And it doesn't have to be a lower price. It could be to fix something or change something in the home to make it more suitable to your needs. But whatever that final price you agreed upon, your goal is to really have at least 20%. And the reason to have at least 20% is because having 20% in most cases means that you will avoid having to pay for private mortgage insurance, or PMI. PMI is insurance that you pay to the mortgage lender. It's to cover the liability of them giving you the loan. So really, why does it exist? If you couldn't even afford to put 20% down on the price tag of the thing you're paying, they want to make sure they're covered in case you don't end up paying that loan back. So that insurance will pay them even if you don't pay them. So really, PMI is only good for the mortgage lender. It's not good for you at all. It's actually adding burden to you. So avoiding it is a really, really big relief. The problem is if you don't eliminate it off the bat, it can take quite a bit of time to get to that 20% equity that you need in your home. Even when you get there, they might not automatically cancel the PMI payment. They might keep it going. I've actually heard of people saying they paid PMI years after they needed to, and they didn't know that it was supposed to go off of their loan. And they had to go and they had to call their mortgage lender and ask them to drop it. And then, of course, they did. So don't expect it to automatically drop if you ended up with it. Pay attention. And when you get to that 20% principal or equity in your home, that's when you need to make your move. And you should see that line item come off your mortgage statement. So overall, though, that PMI, it's going to cost you. It can be anywhere between 0.5% to 2% of the overall loan amount annually. This generally is around $1,500 to $6,000 a year if you had taken a $300,000 loan. So a $300,000 mortgage, you're probably paying a couple $1,000s a year just on mortgage insurance. Again, 20% down payment can help avoid this, and usually. Overall, though, when you're trying to think about how much of a house you can afford, the 20% is a good indicator that you're probably fine, that you could afford to buy whatever loan you're taking. But there is a general rule of thumb here. And that is to borrow no more than 2.5 to 3 times your annual income. So let's say you bring in about $100,000 a year. You really should not be agreeing to a mortgage for more than $300,000. I do see that people take on mortgages more than they make. And this can get you in trouble. It can have a high degree of risk. I'll see people lean towards like adjustable rate mortgages, which I'll cover in a minute, to help make the payments more affordable for them. But then they get bitten later when those rates jump up. So just keep in mind, like, this is a big loan. And even though it might sound like, oh, I want to get a house, I can't afford a house, I'm going to have a less down payment, or I'm going to have a worse interest rate, or whatever it is. These things, they do add up and they do cost you. So if you can, even if it might mean renting a little longer, saving a little longer, whatever it is, it could be worth it. And the reason I'm saying that is because there's a real cost, which is larger than the cost of what you're agreeing to pay in that mortgage. And so there's interest, there's taxes, there's insurance, there's that PMI I talked about, there's closing costs, and there's even just general maintenance for the house. These things all add up. You're taking all that on with the home ownership. So let me break down a little bit. First is the down payment, which I covered before. That's the portion you agreed to pay in cash. So you have to have cash on hand. You're going to make that payment when you close on the loan. There's also a loan origination fee just for processing it, and it's a percentage of the loan amount. So you have to pay that fee. You also pay another fee called an appraisal fee. This is required by the lenders to be able to assess the official home value. It can be hundreds of dollars. You can ask to have it waived. I've seen that happen before. So, almost anything can be kind of negotiable. You could have the seller pay that fee instead of you pay that fee. They might not agree to it, but you can ask. Another is the home inspection. This is optional. You don't have to do this. Highly, highly recommended. You have a professional come into the home. It's a third party, and they're looking for issues. And in my experience, they find stuff. Some of that stuff can be pricey stuff, and that gives you leverage to negotiate as a buyer. You could say, okay, well, I really love this home. I'm willing to pay that price, but I can't until you fix the roof, or in our case, it was the fireplace. The fireplace didn't work, and we wanted them to fix that. It can be all kinds of stuff, and some of the stuff can be really expensive. So usually it's a couple $100, but that's usually worth it. And in some cases, you can get the seller potentially to pay that too. But I actually think that's a little harder to get them to agree to, because they don't know you're going to go through with it yet. Anyways, another fee is the title search and insurance fee. So legal ownership of the house has to be confirmed. And so they have to pay. There's a fee required to go and just search for the title of the home and the insurance through the system. This can be $500 to $1,500. It sucks, but you can't get around that one. There's also escrow. So if you agree to escrow, then you have a payment to the mortgage lender at closing, and that could be thousands of dollars. I'll cover escrow in detail in a minute. There's also recording fees. This is paid to record the deed itself. Some states have attorney fees. Some local governments and states also might have transfer fees. The HOA I mentioned, they might have prepayments when you close. Anyways, you get the point. Lots of things when you go and just get the loan, lots of fees. And they can range from a couple $100 to a couple $1,000, but that's going to be on top of the bill. And a lot of that can just get baked right into the mortgage. And so you might, in some cases, if you're not paying that stuff up front, you're paying interest on it. So it's even more than that cost. Again, not to scare people away, it's more of just so you know what's coming, and you can be prepared to get support and do negotiations, things like that. So when you're closing on the house and you're securing your mortgage, generally you can consider 2 to 5% of that purchase price, excluding the down payment, to be added on top. So I don't know if I call those hidden costs, but there are a lot of closing costs that are kind of sitting there and waiting for you that you should be thinking about. So if you want to be really conservative, whatever price you think you're going to pay on the house, add another 5% on top of it, and you can look at that as the real price. But it doesn't really stop there. You have to maintain the home once you close on it. So first, you have your monthly mortgage payments. That's the amount you agreed to pay each month. It will affect your credit score, either in a good way or a bad way. So you definitely want to pay those on time. You also have property taxes. It'll vary when you pay them and stuff, but it's a fraction of a percent, up to 2% of the home's value annually. So property taxes can be kind of expensive. And I'll get in later some tricks and strategies you can use to try to optimize that. There's also homeowner's insurance, and this is required by the lenders. And it can be a couple $1,000s. That PMI I mentioned, that happens monthly. It's part of your mortgage payment. And again, you have to get your loan value ratio to 80% before you can drop it. Your HOA fees, those are going to continue. And then there's just general maintenance. So on top of all that mortgage stuff I just mentioned, you have general maintenance cost, which generally is about 1% of your home value each year. So if you bought a $300,000 home, you should expect to pay roughly $3,000 in maintenance a year. And this could be things like, lawn care costs if you have a yard, unless your HOA covers it or you have a landlord, roof, plumbing, structural repairs. Those are bigger, like the roof and plumbing and stuff. You can expect those to hit every 10, 20 years. The roof doesn't last forever. So it's something you need to think about. Like in my case, I will likely rent out my house in 2 years. The roof's about due. I'll probably do that right before listing the house for rent. Things like that, it will come up, and you have to kind of anticipate a trickle effect of costs and then those big gut punches at different points of time. So overall, your worst case here is over 30 years, you could pay 2 to 3 times that original purchase price. So again, if let's say $300,000 was your goal, you could end up paying $600,000 to $900,000 overall, maintaining the home and through the interest and stuff like that. So what can you do knowing that your dream is so expensive? Well, first, I would start with that mortgage, because that mortgage is going to have the most significant impact to your bottom line. I would start with the loan term itself. If you have a fixed mortgage, that means the interest rate will stay the same the whole time you have the mortgage. But how long do you have the mortgage? You might hear 30 years. That's really common, is a 30-year fixed rate mortgage. But you don't have to do 30 years. You could do a 20-year. That's what I did. I had a 20-year fixed, or even a 15 or something else. So the mortgage lender might have different options when it comes to how long you keep the loan. And the shorter term that you take, the higher your monthly payments are going to be. But also the more you're going to save on interest. So for example, a $300,000 loan, the one we've been talking about, let's say you got an offer for that loan at 6.5%, and you're looking at accepting 30 years. So a 30-year, 6.5%, $300,000 loan. That's going to eventually add up to $682,000 in total. That's pretty significant. Okay, so instead of $682,000, what if you took that 30-year loan and it made it a 15-year loan? So basically, you shaved off half of the loan's lifetime. Instead of having to pay a total of $682,000 by the end of it, you'd only end up paying $471,000. $211,000 savings, but your monthly payments are going to be higher. In this case, $700 a month more. So I look at it this way. If you're able to pay an extra $700 a month, you're only paying interest for 15 years and overall saving $211,000 on your payments overall. So you push it's more per month, but less overall. So making it shorter can work well. And you don't, even if you already had taken a longer loan, you can always refinance it into a smaller loan later, which I'll cover in a bit. The next thing you can do to try to have a more favorable mortgage is try to get the best interest rate possible. As with most loans, it always comes down to the interest rate. Interest is everything here. Now the Fed is actually setting the tone here through the Federal Reserve policy. This is updated every so often, and it's based on inflation and other market conditions. And the mortgage lenders will kind of set the rates from there. But you can shop around. You find the best rate you can get, and maybe potentially you could even negotiate. It depends on all kinds of factors, but really your options here are going to be, are you going to have a fixed rate or an adjustable rate mortgage? A fixed rate means whatever interest rate they're giving, and they're probably higher. That's where we might be seeing that 6.5%. That gives you predictability and stability. Like, you can make a plan against that. You're always paying the same amount per month for whatever the term of the loan is. Now, if you take an ARM, which is an adjustable rate mortgage, it's going to look really promising, right? They might be offering like a 3.5% or something, or 2%, something crazy, but that's not forever. It's actually going to only be for a short period of time, maybe months or just a couple years. Because what happens is they reset periodically. And so those rates are always adjusting, and they're going to usually jump up later. And this is what usually bites people. And, we're making a financial plan here. So knowing that our rates are variable, that's just a risk factor, and we can't really plan well against that. So I'm not your agent or financial advisor, but I would highly suggest trying to think about fixed rates and talking to your advisor about that versus an adjustable rate. You can just have a lot more stability, even though the rate is higher. Now, the amount you put down is probably the biggest impact on the rate. The higher the down payment, the more cash you're showing you can put into it. That's where you have some leverage with the mortgage provider. They might say, okay, well, if you can put down this much more, we'll shave off X% from your rate. That's where you have the most negotiating power. Where you don't have as much power, which could get you though, is your credit score. The higher your score, the better the rate. And this is why when I was talking about borrowing last episode, I was really pushing on that credit score a lot. This is when it pays off, is when we're trying to get a mortgage, or you're trying to buy maybe a car, you're doing a car loan or something. But the mortgage really, because the interest rate impacts this volume of borrowing at so much more. So if you can have that better credit score, you're going to be able to do a lot more. So between the down payment, a shorter term fixed rate, and a good credit score, you might actually end up with quite a good interest rate. So let's use an example for a minute. Let's talk about that $300,000 6.5% loan from before one more time. Let's say we put 20% down. That's $60,000. So you would have saved up $60,000 as a down payment for that $300,000 loan. By having that 20% down payment, you drop your monthly payments $522. So $522 less that you have to pay per month because you had a 20% down payment. Okay, how about though if you had more? What if you had saved 35%? So that's $105,000. They always say 20%, but you can have more. So you say, oh, I have $105,000 I've saved up, and you end up with this. Let's say for some reason you end up with the same interest rate, which likely you get a lower interest rate, but even still, just the higher down payment alone would change your monthly payments to $914 less than what you were paying before. So you cut your monthly payments another 50% by bringing an extra 15% down when you close the loan. So you're kind of winning in all levels when you're bringing in a better down payment. So shorter terms, fixed rates, better down payments. These are good strategies to get the best term loans possible. And you can always go online and use all these great mortgage calculators to kind of play around and see how things change. It's a really good way to see, okay, well, if I had this much down, how much better would my payments look? What if I can secure 0.5% less? How would that affect my monthly payments? Because remember, your monthly payments are big. What you're trying to do is keep your cash flow as high as possible. You know what your income might look like. And if you've been doing the other stuff in your financial plan, you're probably tracking your spending, having an idea what your costs look like. This is an area of optimization, maybe one of the biggest. So if you can get your mortgage lower or your rent lower, well, now you have more cash left over to invest, to save, or to spend. So let's assume you get through that closing. This project's not quite done yet because you're going to start getting mortgage statements. And understanding that monthly mortgage statement can actually help. Because when you look at this, they actually have to disclose all types of stuff to you. And this will allow you to really understand where your payments are going. For example, I mentioned escrow before, and you have to agree to an escrow account or not. Except if you didn't put 20% down, you're probably forced to have an escrow. But what is it? An escrow account it's like a special account where it holds money, where the mortgage lender will use that pool of money to pay some of your home costs, home related costs. Really, they're going to pay your property taxes and they'll pay your homeowner's insurance. So instead of you paying your property taxes directly to like the county, on you paying your homeowner's insurance, they will have you pay into this escrow account based on some estimate that they'll come up with of how much you probably should owe that year. They don't know, they're guessing, but they use it like a budget. And they're taking portions of that payment from that escrow account and they're making the payments to pay your taxes and your insurance bills when they're due so that you don't have to do it, which that's nice. It's kind of convenient, right? But sometimes they're wrong and they have to adjust it. You might end up having to pay more that year, even though you already paid into the escrow account. They'll send you a bill and say, sorry, we were wrong. We were short. You have to pay the difference, or you'll have too much in there. And that might mean you have to pay less in there next year. Again, they're just estimating and budgeting. But you might go, hey, I don't want to pay any fees or anything for this escrow service. I'm going to just do it myself. I mean, that's what I did. But again, if you didn't put 20% down, they might require you to do it. Additionally, you'll see fees, taxes, how your monthly payment's broken up, things like that on there. So take a look. Are there late fees, service charges, things you didn't expect to see? You just challenge those things if at least see where that money is going. And what you'll notice is that your actual payment, thousands of dollars you're paying a month, some of it is going to interest, some of it's going to principal. So what that means is that the interest is the premium you're paying for borrowing the money. The principal is the actual money going into your home as equity. Early in the loan, most of it is going in as interest, but that will die off throughout the lifetime of the loan. This is called amortization. An amortized loan is one that's going to die off over time. Amortize comes from the Latin root amateur. I can't actually say it. Amortize, amortir. Anyways, it's the Latin word to mean killing off or kill off. And that's because you're gradually killing off your loan. So over time, your payments are killing your loan. There's no appreciation in the loan itself. Because of that, you're paying the same amount every month. That's called an installment. And your money is going in based on a schedule. So based on that schedule, X% is going to interest, the rest to principal. And over time, more of it will start moving to principal, less to interest as you get towards the end of the loan. So if you really look at your amortization schedule, it's pretty stacked against you. They upfront all the interest on you. They're front loading it. So you're not really buying into your asset that much. And so if you only lived there for a few years, you're mostly paying interest. You're not getting a lot out of just living there. If you can live there longer, of course, you'll start to get a lot more principal in there. And then we can talk about other strategies you might do. The main thing to keep in mind is if you take a 30-year loan and you end up moving just after a few years, mostly they will have collected interest from you, and you'll be starting that amortization schedule all over again. And if you do buy another home. So one way to struggle getting ahead when it comes to home ownership is to move too often and continuously take new amortized loans. Something to keep in mind. The next set task to think about for this project, though, is to think about developing an overpayment plan. And this could be a separate project for you if you'd like. But the idea here is that even if you were to put an extra $100 a month into your mortgage payment, you can save thousands of dollars in interest overall. It will go far. And the reason is because any extra amount you put into your payment all goes to principal. So this is a little bit of a cheat code. Instead of being stuck paying to their schedule, you can start to chip in to past the amortization schedule and get money straight into principal, building equity in your home much faster. Any extra money you do will go and do that. And that's why having an overpayment plan can be very powerful. You can look at your schedule. You can think about, okay, how can I get ahead? When in the lifetime of my loan might I need to borrow money back out of my home? When do I want to pay off the mortgage? Things like that. You can build a plan against it. So the interest you're paying, though, is tax deductible. So there is benefit to the interest. I think I covered this a lot in the last episode. And if you're working and you're itemizing your deductions, you probably care about that. It's probably one of your better deductions. But again, if you get into retirement and you don't have enough income that you need to itemize against, and you start taking a standard deduction, that mortgage insurance is not going to really help you. That mortgage interest, the interest is not going to really help you. It's really going to hinder you. So overpayments can help you, take that loan down and pay it off earlier, or you can do a large lump sum payoff towards the end if that's more your style. But my suggestion is to think about overpayments early, because getting more principal built is good, and you're taking overall interest off the lifetime of the loan. The last thing I'd like to touch on this project is refinancing, because getting a loan and paying a mortgage, that's fine. And hopefully you got the best rate possible. But what if the market changes? What if things get better and you see other people who are getting better rates? Well, you aren't stuck. You can actually refinance your loan to get a better term for yourself. And this can be really lucrative. If you can drop it even 1%, you can save yourself thousands of dollars in the lifetime of your loan. And so let's go back to your fixed rate, right? Let's say you took that 15-year fixed rate loan. You can refinance it into a new fixed rate. And so this is just basically taking a new loan out, maybe even with a different lender if you want, to pay off the current loan. And everything's game. You can change anything. You can change your interest rate, your loan duration. You could go for a 15-year. You could get, if you were an ARM, you could get off of that and get back to a fixed rate. You could even make sure you're eliminating your PMI. So if you had PMI now and you didn't get to what you needed to, maybe you could move that to a new loan, refinance it, try to get rid of that. In some cases, you might end up deciding to take out more than you owe and just take the difference back in cash. You could do that. And that cash could be used to pump back into home improvements, or you could use it to invest. Keep in mind, though, refinancing isn't free. It can cost between 2 and 6% of the loan amount. It's paid when you're closing on the loan. So just like when you did the original mortgage, when you refinance, there's a closing that occurs. And there's application fees, new appraisals, another title search and insurance, credit checks, all those things. They can add up, and that's something to keep in mind. But you can do an ROI and see if the savings is beating the cost for closing it. It can make a big difference. That $300K loan, a 6.5%, if you refinance that to a 5% loan, just 1.5% less, you'd be saving $250 a month. That's $60,000 total in savings by going 1.5% lower in that interest rate. Also keep in mind, there are programs that can help you when it comes to just financing a home in general. The Federal Housing Administration, FHA, they have loans that can lock in lower interest rates as long as you have a credit score of like 580 or higher. There's also conventional loans, like normal loans that you can get that are 3% down payment for a first-time homeowner. So instead of 20%, you can say, okay, well, I'm going to use this first-time homeowner privilege and only have 3%. But again, there's only having 3%. Understand there's more cost there. The VA, the Veteran Affairs, they have loans that can waive the down payment for eligible veterans, which can help them find affordable housing. The USDA loans have no down payment as well, and that can be good for people in low income areas, and it's only good for rural areas, lower income buyers. But this means these programs exist so people can get housing. And so if you're a veteran or a first-time homeowner, or you think you qualify in the lower income rural area, you can check these like different platforms out, see if those programs you're eligible for them, and then maybe even you can find good terms through them. There are also some states that offer down payment assistance programs and even tax credits and deductions through something called a mortgage credit certificate. That gives a tax credit for a portion of your mortgage interest payment. Anyways, there's lots of stuff. There's even like the Department of Housing and Urban Development, HUD, has programs for teachers, firefighters, police, EMTs, and it's just so that they have access to discounted homes. What I'm getting at is like, think about, maybe you have an eligibility that can help you as well. It doesn't always have to be refinancing. It can just be getting a discount. The last thing I want to note here as I close out this project is about first-time homeowners, because there are privileges for first-time homeowners. And you might think, oh, well, that's not me. I've owned a home before. But the actual legal definition isn't someone who's never owned a home. It's just people who are buying a home for the first time, or anyone who hasn't owned a home in the last 3 years. So you might have owned a home and foreclosed or sold or whatever, and that was and you've been renting since then. You can qualify for some of the benefits of a first-time homeowner. Look into it and see if that's interesting to you. Honestly, the biggest one I know about is the ability to withdraw $10,000 from an IRA penalty-free before you're of age. This will be taxed as income if you do it from a traditional. So Roth is usually best here. But anyways, if you've been saving in a retirement account, you're like, okay, well, now I have to have this big home cost. Think about how much more $10,000 would do for you as a down payment. Your normal down payment plus 10. It could be worth it, but you always think about the loss of gains that you would have in your IRA. So you have to kind of weigh those against each other. Project 3 is all about increasing the value of your home, because once you get through all that mortgage stuff and borrowing, and it's your home, you're trying to make the most of it, and you're hoping that it's going to appreciate and have value for you. But you don't have to sit and hope that it works out. You can take some actions. And this project is about making a plan for actions to increase that value. And the first section of tasks to consider would be all around renovation, or just generally upgrading parts of your home. Because improving pieces of your home can improve not just the value of it, but your overall lifestyle. But some improvements will go further than others. You can look at the ROI, or return of investment, based on how often people get higher sell prices based on certain renovations. And the highest for sure is kitchen. Kitchen renovations go very far. People will decide to buy a home and pay more because of a kitchen, but bathrooms can work as well. General curb appeal is a good one. If someone loves the way your house looks and you've done a lot to make it look well, you can go a lot further. So these are very high ROI improvements and can be worth your time, but they can be pricey. And if you want to be able to recoup that price if you can, and you may not be able to recoup it until much, much later. But if you're looking for help on that part, you might want to consider taking another loan, but just for the home improvement. Because as you pay into your home, you at some point may be allowed to pull that money back out. It's not completely locked up. So you would go through your bank here or another lender, but they can give you a special type of loan called a home equity line of credit or a HELOC. So the more equity you built in your home, the more you might be allowed to pull out of it. Now, it depends on the provider and there's limits and stuff. The nice thing though is they typically give you a better interest rate. So instead of you taking a personal loan at, let's say, 10%, you might be able to see that you can get just the same amount of money or more through a HELOC at a lower percentage, say like 6 or 7%. That's pretty great. Also, if it's through your bank, it's easy to transfer money and manage the account and all that stuff. At least that's what I found. Anyways, these can be more favorable rates. And the reason is because they're using your home as collateral. So keep that in mind. Your home is collateral. So if you defaulted on that HELOC, you didn't actually pay it off or you can't pay it off, they actually, in the very worst case scenario, could potentially put a lien against your home or maybe seize it. It can get serious. So make sure you can pay off that money you're taking back out. And when you do take that money out, try to make it worth it. There are definitely stuff I'll cover here that have higher ROI than others, but some stuff it really has not proved to have a lot of value. So you might want to avoid certain things like installing an in-ground pool. That's one that typically has a high amount of cost and no return. Also, if you're doing like luxury market style upgrades, like luxury bathrooms and kitchens and stuff in a market that just isn't built for that, you're not going to get the right type of client interested in purchasing the house if the neighborhood isn't the type of place they want to live in the first place. So you're just kind of wasting your money by doing that type of upgrade. Also, like if you make a if you make a room too niche, like if you took a bedroom and you did customizations in it to make it into a permanent office, that can really bite you because people like the flexibility. They may not want that office. They might have wanted a bedroom or something else. Another is if you have a garage and you convert it to a livable space, you might think, oh, that's great. That's another bedroom or something. No, losing a garage really can hurt the price of your home. So, you got to be careful with that. But like a sunroom, that's another one that typically is hard to recoup and things like that. Anyways, you can kind of look and say, well, some have good value, some don't, and just be honest about where you think you can get your money back. The next thing you can do, though, in this project is think about optimizing your utilities and taxes. And this is about lowering costs where it makes sense. And so you're putting your money into things like installing energy efficient systems, things that aren't only good for the planet, but also for your bottom line, your bank accounts. And you can look into these upgrades as being things that are not only going to take your monthly bills lower, but they're things that you can even get rebates for. I did this. I installed a hybrid pump system, and my utilities company gave me $8,000 back on that. So that was great. That was a big rebate, and I've been saving a lot of money from this a more efficient heating and cooling system in my home. So anyways, check with your utility company, check with the manufacturer, or even look for tax rebates, because there is a federal tax credit of 30% when you do things like insulation, windows, doors, heat pumps. There's also a resident clean energy credit of 30% when you do solar and battery storage and geothermal stuff. I've taken advantage of both of those myself. I did a solar system with a hybrid heating and cooling system. And on top of that, because I'm in early retirement, I get a deduction on my utilities. And so together, my utility costs have just gone way, 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 way down. In some cases, I get credited instead of paying for energy. I'm not saying everyone can do that, but so these things can pile up and they can make your life easier as well. So if you're thinking about this, you can actually even optimize when you do it, not what you do, but when. Think about the season you're in. Maybe you're adding air conditioning. Wait till the winter. when the demand for AC units is at its lowest. That's the best time to find a discount and bring business their way. Things like that. Plus, people are more available and you get better customer service. So anyways, look for optimizing energy costs, tying systems together, create automation. Like having an automated system means that you might, it can do more than you can do manually configuring it yourself, turning off lights when people aren't in the room, making sure the heat isn't going past a certain setting, little things like that can save you money. Next category is property taxes, though, and that can be one of the most annoying parts of home ownership. So what'll happen is there's an assessment, and this assessment is basically saying how much your land and property is worth, and that's how much taxes you're paying. And that assessment can feel very disconnected from reality sometimes. You get this thing in the mail, and if not, you can go online and look at it, and it'll say your property went up X percent, and now you owe this much more. The good news is you can actually appeal these things. You don't have to just take it because, how did you determine that? Like, you didn't come to my house. How do you, there's things they're doing, but they're expecting people who care about it to appeal it. And so if it looks inflated, you can go to the website and you can push for a correction to save on those ongoing taxes. So look at like the square footage they list, the number of beds and baths they list, or if they marked your basement as finished or not. Most importantly, though, look at comparable homes, because I think this is how they do most of it. They go, oh, your configuration or whatever, there's a house, a couple miles away that's similar, that's sold for X amount of money. So we think yours is comparable to that. That's generally what they're doing. So you can actually go and you can search for that, and you can provide evidence that actually no, that was a fluke, or most likely it would be this other price. But anyways, you can upload photos and all kinds of stuff. You can even pay for an independent appraisal if you want to, and that can work really well. But the goal is you're just refuting it. No lawyer required. And maybe you might be required to attend an appeal hearing. It depends on the area, but a lot of times they'll review it, and they might go to a lower value. So overall, your goal is to look for areas you can save on money. So be honest about where things are expensive, including your taxes, and generally try to think about increasing the appeal of your home, because when you get down to it, if you're able to stick it out, you're going to get to a point where you're either going to sell the house or you're going to rent it out. When you get to that point, a little love can really pay off, because what you're trying to do is maximize the appeal, even by doing just even little stuff, so that you can even get more back on the return. A good example would be spackling and painting walls, right? And you're living in the home, you're chipping paint, you're hanging stuff up. Go and patch those things up. It's really cheap and easy to do, and paint the walls to something that might be generally appealing to people. Declutter space. You could even store stuff. Just get it out of there. Just make it look more open and comfortable. Go and do some landscaping. Clean up the curb in particular. First impressions matter. Try to make it look as nice as you can. Replace dead light bulbs. Anything that a renter or buyer might notice. And that stuff can equal real money. And it might be stuff you're doing anyways, but just a good reminder. But the big thing is to think about those big gotchas that a buyer might use to leverage a lower price. These are the things that can't really be refused. A lot of things can. Like if you're selling or renting, you can, no, sorry, I'm not going to do that. That's not reasonable. But sometimes it is. It's like when I mentioned my fireplace. They had to fix that. It was a completely non-working fireplace. They had listed a fireplace. And so it was fair for us to demand that they repair it. And that turned out to be pretty expensive for them. They had to do it in time for the closing. They had to get a specialist out. They found bats in there. They had to remove a nest of bats and then fix the flange or something. I don't know. They had to do a bunch of stuff. And that's not fun to have to do it that way. What would have been better is, either fixed it earlier on their own schedule so they could have enjoyed that fireplace, or even better yet, they could have upgraded it to something that was not going to break down again. You could have an electric fireplace that could have looked really nice, been more energy efficient. I don't know. Like whatever it is, like the point is like think about those things that could come up, get ahead of them on your own schedule. Don't give those buyers any reason to demand more. The other thing to think about in this project is how to simplify your just overall living costs. Because as we expand the size of our home, we expand the size of our life. We generally will fill it up with stuff, and those things cost money to maintain. So one thing you can do here is start to eliminate the expensive amenities in your home. For instance, if you have a swimming pool, it generally costs about $2,000, $1,000 to $2,000 a year to maintain it. That's pretty expensive. And if you're not swimming in it, that's just wasted money. Now, I'm not saying you're going to have to go fill your swimming pool, but maybe. I mean, if that's costing you money and you don't think that's a big feature of the home. Hot tub's a better example, I think. It's less expensive, but it still has a high degree of water and energy cost to it. And that's not exactly something that's going to sell your house. Other examples would be wood burning fireplaces, subscription-based security systems. You're paying a monthly fee there. You maybe not getting a lot out of it. Old broken down gutters or HVAC stuff that's not working well and efficiently. Think about those things that are just costing you money and that you could just upgrade or just get rid of. And that's the goal here. It's to provide your life more simplicity and save you some money. Another more, I wouldn't say extreme, but another thing you can think about is just reducing the overall square footage for a more minimalist lifestyle. Let's say you have 2 rooms and you're maintaining both those rooms. You're heating, you're cooling, you're cleaning, you're doing all that stuff. Combining them into a multi-space room could work. You can convert a spare room into one, or pick one and just make it work for both. So a bedroom office or whatever it is, it just gives you less to focus on. Hopefully, you can optimize there. If you have like a large formal dining room and you're not really ever using it, you can just get rid of that and open up the space. Sell the stuff, get the money for it, have that space open. Or convert it to something, more useful for you. Also think about leveraging your attic, your basement for storage instead of closets. If you have stuff that you're just never using or accessing, put it in an appropriate container somewhere else. Open that space up. Just be careful not to refill that space with more stuff. That's a problem. If clutter is ruling you, it can be tough. But generally minimizing the amount of rooms that you're maintaining can help a lot. But the big thing I want to talk about is adopting a DIY lifestyle, because a lot about home ownership is about doing it yourself if you're trying to get ahead. And YouTube is your friend here. Pretty much anything in the world you want to do, you can find on YouTube. I know, because I literally took a dryer apart piece by piece and actually soldered a new part onto a circuit board, put the whole thing back together, and it's been working for many, many years ever since. Thank you, YouTube, for showing me how to take a dryer apart and put it back together. It was an LG dryer. It was brand new. It stopped the heater. It stopped working, and I had to go and replace that on the circuit board. So it's all possible, believe me. I just installed a microwave myself. Our microwave finally died after 17 years. I went to Lowe's. It's hard to find anything in stock in person anymore, but they said, here's a microwave that would meet your needs. It was about $200. They asked me if I wanted to do the delivery and installation. It was going to be $300 for them to bring that to my house, remove the old one, and hang up the new one. Well, I'd already dumped the old one, so I didn't need them to remove anything, and they didn't have a way to just do the install without the delivery. So they were asking me to pay pretty much more money just to go and do the labor. And instead of that, I said, no, I'll do it myself. And there's instructions, there's templates. You can do it yourself. I know that's scary for people, but it's rewarding to do these things yourself. Just be honest about your limits and, strive to try to do it yourself, because labor can be quite expensive and you can have more pride that you know how to maintain your home. Finally, like if you're retired, check if your utility companies offer any kind of assistance programs, or if you're lower income as well. Lower income, retired people, we have access to certain privileges because of a lower income level. We can shave off a portion of our monthly costs this way, lower electricity bills or other services. Look around for that. Your home doesn't have to be as expensive if you're not making as much money. The last thing I'd like you to consider here is just reimagining your space. Are there creative solutions you can get out of your home? For instance, is there space in that bonus room you have for a closet? Could you turn it into an extra room? You get a lot of value out of that. If you put hardwood floors in, would that open the space up and make it look more modern? You could get a lot of value out of that. Could the garage work as a rentable office? If you're not using it for anything else, that could be a good income source. Do you have room? Do you have a large yard? Maybe you could put a mini home up. That could be a good investment. Incorporating shelving into cabinets and walls, under stairs, beneath beds. You can make a lot more space for yourself when you start to do those types of things. Or you could even convert a walk-in closet into a mini office or a reading nook. You can make your space into something great. These might even become features for when you want to list the home later. All right, the last project is all about how to build up rental income. This is about turning your home into income, and there's actually multiple ways you could do it. The first is the HELOC I had mentioned, the home equity loan. This is where you're pumping your own home for leverage. You're basically, the cash doesn't have to be locked. You're pumping it back out, but at a premium. You have an interest rate, and you're taking that cash so that you can reinvest back into that same property, increase the value, or put it into an investment, or whatever it is you need to do. But borrowing from your home is one option. The next, though, is actually creating actual passive income through rentals income. And to do that, you should be thinking about what you can rent out. It could be a room, it could be a basement, it could be an entire home, or it could even be a new property that you're purchasing. And this is great when you can start to establish it, and you can even start with your primary residence. Just check your local laws, and if allowed, start to look at the ROI for renting versus selling your house. And what you're doing is you're aiming for a 6 to 8% cap rate. Cap rate is the net operating income, which you divide by the purchase price and then multiply it. In other words, so it's a metric that you're using to estimate the return on your investment. So look at the annual rental income that you would receive. So whatever it is you think you can make renting out that space per year, and then subtract all your operating expenses. So, you're paying property taxes, insurance, management fees, whatever it is. Just take all that stuff out, then just divide that number by how much you paid. And you should see like some percentage. If that percentage is between 6 and 8, then it's generally considered a good balance between risk and return within the real estate market. So that was a long way of me just basically saying that you're trying to find a cap rate where you're doing well with rental. And you can use this to assess, is it worth renting something? I have to pay X amount of money and I have to operate it for Y amount. Am I going to make back enough to make it worth it? And so you can use the cap rate calculation to help you do that. So you can have a task for calculating cap rate for a room or for a home or a new property. You can also consider, hedging other areas of your portfolio by converting cash into real estate. So maybe you have too much stock and you started to cash in and you have some taxable stock gains. Well, you can take that cash and you can use that as capital for real estate investments. This can lower your overall tax bill for the year. Now, real estate's not the same type of investment as stocks, but so it's not directly offsetting the gains. But as long as that real estate is being used as an investment or for business purposes, then you can actually deduct it. You can't live in it though. It can't be your primary residence. But this is a way that you can actually lower your taxable bill. So you purchase this new real estate. You deduct a portion of the cost of the property to reduce your income. That real estate is considered a capital loss for the year since you just bought it and it just started renting it out. This is the key. You just sold stock. That's all gain. But you just purchased real estate, all loss. But you're planning for that real estate to start to generate some gains for you later. But for that tax year, your situation's better. If you had held those stocks for at least a year, so you have long-term capital gains on them, you will pay capital gains tax for what you sold. It could be 0%, 15%, or 20%, depending on your income bracket. And that cash in real estate, even though it doesn't offset the gains, it will help you solve your tax problem while setting up passive income. If the real estate investment doesn't end up appreciating, like you don't actually start seeing any value coming out of it, you might even be able to claim a depreciation on it later to further reduce other tax burdens in future years. There's a lot there. I mean, clearly you would talk to a CPA, maybe an advisor on this, but taking your cashing out gains in one portfolio to start to build up another part of your portfolio to create passive income, that's what I'm getting at. And it can help you optimize your taxes while you're doing it. So think about all that. And later though, eventually you're gonna have to sell this real estate. And when you do, you might have a recapture tax. It could be up like 25%. So it's not like you're never gonna pay tax, but it's about optimizing for the year you're in while setting up a new income flow and, you know, kind of moving stuff down the line. So again, something good to chat with like a CPA about. I'm actually planning on doing something similar to this in my own life. Right now, I've been tax gain harvesting, had quite a few gains in our stocks, and looking to get more into real estate. Now, my son, who I featured on a previous episode, is going to college. He will live in a dorm for at least the first year, but we're looking to buy property in his area. It's a really great area. It's good growth. It's a great market. And we'll rent out like a condo, right, in that area, something like that. Eventually, though, he's going to need a place to stay. And, you know, I've been helping save for his college. And the next episode is all about how to save and pay for college. But anyways, housing is one of the biggest costs when it comes to saving for his college. And, you know, we could have done better there. But part of my plan was to not have to do as much because I was going to be able to provide him housing. So by having this condo, getting passive income from it, later I'll be able to provide him housing through it, rent-free, while he's finishing up his degree. And then when he's done, I'll be able to continue to rent it out. Again, you know, you can have plans like this. This is something that's helping with my tax situation. It's helping me with my kids' college savings goal, and it's helping me with my passive income goal. So having a multi-goal project here is really great. Also keep in mind that once you're in real estate, things can be simpler. There's 1031 exchange laws where you can defer your tax gains when you sell one of your real estate investment properties and reinvest it in another property of equal or greater value. That's another way of saying you're basically investing up, but it's because you're doing similar investments, real estate to real estate. You couldn't do that but from your stocks. So 1031 is only possible within real estate, but you know, you can think of it this way. You're kind of getting your cash into real estate. The ball gets rolling, it appreciates. You can do a 1031 exchange. You can roll it up, and you're enriching your portfolio. Anyways, that I won't go into that in more detail, but it's something to think about as you're building up your rental income. The next piece, though, is about vacation rentals, because you don't have to be a landlord. You have other options. And doing this can bring even more rental income in per month. This is the Airbnb and Vrbo option. There's other platforms, I believe, but this is what allows an owner to rent out properties or rooms to travelers. You probably have done this yourself, but this is actually quite lucrative and very popular, and a lot of people do this now. But renting out is a great monthly income, and something like Airbnb or Vrbo, you can do it frequently. So instead of having a single tenant or multiple tenants leasing it for whatever, like a year at a time, you are doing like maybe daily or weekly rentals, potentially even at higher premiums, like during holidays or certain, events. But you have to check laws and restrictions here. You can't do this anywhere. Like some places like HOAs and others will actually prevent you from being able to do an Airbnb. So definitely look into it, make sure it's an option before you try it. And also keep in mind that the amounts can vary. Like you set the price, you set the rules, you set availability. Guests may not book it. You might have no income one week or month or year. I don't know. It just depends on what you're doing. So, income isn't as steady as it when you do the landlord rental, but it can be higher and you can do really well with it. Plus, the platforms do a lot of the lifting here. They're matching guests to you. They're making sure secure payments come through. But keep in mind, you're getting reviewed on the service you're offering. Now, you could pay somebody to be an intermediary, or you could try to do it yourself. Whatever you do, though, keep in mind, it's not 100% passive. Then, the rating will matter. So, some effort will need to be put in there. But still, this can be a great option, especially if you want to access that property for yourself. Block it out, use it yourself. It can be an extra thing for you that you can enjoy. The very last thing for this episode I want to mention is renting out a piece of your property, like your attic, your shed, even your driveway. Any unused space can be potential rental income for you. You could rent out your driveway for an event. You could even do it for long-term parking. Rent out your attic or shed because someone wants to store stuff. Storage is a big deal. Because so many people struggle to find homes, that doesn't mean they don't have stuff. They need to store it somewhere. So utility sheds and things like that have been doing really well. Being able to offer that could be an income source. Or your basement as well. If you have a basement, you could rent that out. There's platforms like Neighbor or Spacer. These are places that you can look at if you think that could be a good option for you. Whew. Okay, that was only 4 projects, but a lot of stuff packed into them. Just like with the last episode, this is a biggie. I did not cover everything. I didn't talk about how rental management companies work in detail, or tenant screening software, or I did mention 1031 exchanges, but I didn't really explain exactly what they are, how they work. I also didn't cover real estate trusts. And I will say real estate trusts are a good idea, especially when you're looking at buying and renting, multiple properties. So these are all good topics and worth understanding, but we'll get into them in future episodes. Overall, though, I want to just say that, as a buyer, renting versus buying a home, it really just comes down to a lifestyle, flexibility, and long-term goal that you have. Renting can give you freedom. It can lower risk, especially in a high-priced market. But when you buy, you're getting stability and equity and growth. So there's value in both of those things, and deciding like what's the right time and where I am in my life and what I want to do. You can use data and calculations to help you make those decisions, but ultimately it's going to come down to opportunity. Like, can I find the right place and the right price? But also discipline. Like, you can always think about saving and being ready to make a move. And securing that favorable mortgage, it can save you a lot of money, maybe $10,000 or more over the life of a loan. Pay into principal, it builds equity. And then you can leverage that for future goals like education or retirement or income generation. So overpay on those mortgages when it makes sense to do so. Let's circle back. I had mentioned Irvine at the beginning, and he was looking to move out and was kind of figure out, should he rent or should he buy? What should he do? And so he starts by just calculating his rent versus buy scenario. And he sees, okay, for this amount of money and where I might want to live, these are my costs. What makes sense? And he finds that there is an area where he can have a modest home, and he gets pre-approved for a mortgage. He starts to run some of his numbers through a mortgage calculator or through like a tool like the Escape the Clock Planner, and he kind of sees, okay, it's going to take X number of years to pay this. I can afford to pay this much extra per month, and in 25 years I'll be at this point. Or if I put this so much more in, I could maybe pay off my 30-year loan in half the time. And he starts to come up with an overpayment plan. And he's taking advantage of being a first-time homeowner, looking for whatever discounts and opportunities he can get. And ultimately, he knows he can always fall back on renting if he needs to. But ultimately, he's excited with the opportunity of starting his first home, hopefully appreciating it and rolling it into something better later. We also had Maria. She was looking to start building up her rental income. She had already owned her home, fully paid it off, and she realized that that was a good opportunity for her to get started. She starts to analyze the market. She's looking to move, and so she wants to understand what would be a good investment for her there. And she starts to run some rental income models and also to talk to a tax advisor on any of capital gain implications, which is very important. And starting with renting out part of her current home, she decided maybe buying a duplex might be a low risk entry for her into the real estate market and provide her that passive income she wants. Ultimately, she's looking at, how do I get my feet wet here carefully? And she might even consider maybe getting a real estate trust set up as well. Overall, I hope this has been helpful. I know these long episodes has a lot of information in them, and I can maybe start to break this stuff down even more in the future. Just want to mention, like, a home, it's a place to live, but it's also one of your most powerful financial tools. Well, whether it's building equity, reducing housing costs, generating income, how you finance and use your home can really accelerate your path to financial independence. So when you're thinking about your home, just try to think about making it a part of your plan, and that will set you apart. Well, thanks for listening. Next time, I'm going to go into how do you go through that other big life expense, which is helping fund someone's college education. I'll see you then.
Thanks for tuning in to this episode. Remember, while I'm not yet a financial planner, I am getting my degree in wealth management. You should take anything you've heard here as tips and advice to making your plan. To learn more, visit www.escapetheclock.com. There, you can find the book, resources, including the planner, and you can even schedule time with me. Please remember to like and subscribe so you don't miss an episode. Thanks for tuning in, and I'll catch you next time.